A very warm welcome to HYCM's workshop with myself, Giles Coughlin, Chief Currency Analyst. Lovely to see you. Looking forward to taking us through the session. Hope everybody's doing well. I hope everyone's having a good week. If you just let me know you can see my screen and hear my voice okay, that would be super. Just having a look, checking everything's okay. Yeah, that's all great. Okay, well, without further ado, going to get set straight on to the webinar. Now, remember, on these workshops, the whole idea is that you look over my shoulder, someone from a professional trading background, you see how I make decisions. I'm not giving a signal trading service, even though we will talk about different instruments, exits, entries. The whole idea is that you can see how I go about understanding the market, and over time that will develop for yourselves, and you will understand how to navigate your way through markets and understand, what's the bias for different currencies and instruments. With that being said, there's a couple of things we're going to look at today. We're going to look at trading non-farm payroll, big event coming up at the end of the week, so we want to be over that, and we're going to look at oil out of the OPEC meeting. So that will be on top of our usual, which is the most important principle in trading, which is why I go over it over and over again, because this is something I go over again and again and again. We want to pair strength against weakness. So we want a strong currency against a weak currency. We want to pair a currency that's looking at raising interest rates against a currency that ideally is looking at cutting interest rates or neutral. So that's what we're looking at. So we're going to look at those three things. And we're going to start off by looking at the strong and the weak currency. And I've got a good example for us today, which I'm looking forward to taking us through. Now, the currency pair I want to take us through is the pound Swiss franc. Now, the pound Swiss franc has been pretty range bound recently. There was an attempt to break out recently of that recent range. Now, that was on the Bank of England interest rate meeting. It took place last Thursday, and the reason the pound was looking to potentially break out of that trend line was because the outlook for the Bank of England has been really looking quite strong. COVID-19 cases, although they're rising, hospitalizations and deaths are down. The UK has a huge amount of savings. I think the Q1 2021 savings are up like 21%, second highest savings on record. We have the fact that over 50% of the UK has been vaccinated now. We have a situation where the UK economy is primed to bounce back. Restrictions are due to be withdrawn 19th of July, 3 weeks' time. And it looks like the link between deaths, hospitalizations, and cases is breaking. Now, let me show you what I'm talking about here. Now, look at this. Here's the cases of COVID-19 cases. At first glance, you think, oh, woe is me. Look, the UK cases moving much higher. But this is the important thing to grasp. It's not case number that is now the significant event. Since we've had the vaccine, the significant data is how many hospitalizations and how many deaths have there been. Here is the UK hospitalizations. Do you see how hospitalizations are comparatively low? Now, if you go back here and you look just before November, so just see November 16 cases were going down. So if you look around sort of October, you can see that cases were high. And looking around October, you can see that hospital admissions started to rise. There's a lag between cases and hospitalizations. So the big question is, has that been broken? And the early indication is if it's not completely broken, it's been weakened. So this means the rising COVID-19 cases in the UK, even though the Delta variant is present, even though it's more transmissible, if it doesn't result in extra hospitalizations and deaths, the UK is primed for a faster recovery than many nations. So if you take a look here, UK, nearly 70% of the country has some kind of vaccination. So the UK is looking strong for an economic rebound in the second half of this year. Now, the Bank of England meeting, the last meeting, don't forget, always follow my blog, come along, check out my central bank watch. Now, I was buying the pound into the last Bank of England meeting because I was expecting them to be more upbeat. In the end, they weren't. But what they did do, they revised up growth, they revised up inflation, and so the outlook, according to the Bank of England, is looking better. The second quarter GDP forecast is now grown to plus 5.5%. So UK is expecting a decent recovery. So I am expecting dip buyers, pound yen and pound Swiss franc seem very decent. If you just take a look at the central bank watch and you compare the Bank of England to the last SNB meeting, the last Swiss National Bank meeting, they've got the lowest interest rates in the world, minus 0.75%. Inflation forecast marginally higher. The takeaway is that the SNB is very much on hold. It is more upbeat, but remember the SNB, what they fear is a strong Swiss franc. If you just have a look at the Euro Swiss franc pair, this is a pair I'm long at the moment, have been for a while. If you just look at the Euro Swiss franc, can you see how the franc, look at that strength all the way from September 2007. The Swiss hate their Swiss franc being strong. They really despise it. They've done everything they can to stop its strength. And we do seem to have reached a pretty decent floor here. You know, so a good long-term trade is, you know, at market, stocks just running below that 1.0600 level. Look great for a long-term trade, potentially looking higher up towards that, you know, even that 1.19, 1.2 level. So it is another good medium-term trade. But the point is the Swiss National Bank aren't expected to do anything. They don't want to see the Swiss franc strengthen. They want it to weaken. So they're quite happy to keep their interest rates at minus 0.75%. And they want the rest of the world to increase their interest rates. So there is this incentive for the Swiss National Bank to keep the Swiss franc weak. Okay, you can see going back here, if you go back all these years, look, you zoom out, you see how the Swiss franc has strengthened. They want to see it weaker. This is a potentially great opportunity. And I'll give you the three options there are. Option one, a pullback to 1.2400 would be a great opportunity to go long. Okay. Option two is a break of that trend line, of either this trend line here from April 2021 down to June 2021, a break at that level, lovely, or a break of this level here, just above that 1.2850 region. That's option one, that's option two. Option three is at market with stops running below 1.2710, okay, looking for an early breakout. The risk with that one is that price, you might get stopped out, it might move lower. The benefit is you could potentially get in early underneath that trend line. So you know how it is, it's risks and benefits. The beauty of this, there is also Harami inside bar pattern. So there's a bar, inside bar, Harami inside bar. I was long on the break of this. I'm long the pound Swiss franc personally. So this is a trade that I am in. And I'm looking for this to keep moving high, and I'm happy to hold it through any drawdown, back down lower. So if we do go down lower, I'm still happy to hold. But generally speaking, if you're new to macro trading, like, okay, just keep your stops tight, because the beauty of going with the breakout, as long as you stay above that trend line, stay with it. And if you get dip below, exit the trade. Similarly here, stay above the trend line, stay with it, get below, get out. That way you can really define and limit your risk. Now, there are some risks to this. The risk is that the Bank of England, and this is, you see, Andy Haldane has now left the Bank of England. He was one of their biggest hawks. He's leaving the Bank of England. So it means that the Bank of England don't have one hawkish member. So they have taken what I called an abundance of caution. That may carry on longer. And if that carries on longer, then we could potentially see a little bit of downside in the pound. So we could see some more range-bound action. But that is the principle that I've laid out there, and that principle is the principle of pairing strength against weakness. You see how the strong currency is potentially the pound, pent up savings, Delta variant not resulting in extra hospitalizations and deaths, the Bank of England expecting a strong economic recovery. That's all pound bullish, right? Weak currency, the Swiss National Bank, they consider the Swiss franc highly valued. They intervene in the currency to weaken it. They want to see it weaken. They have no intention of raising their low interest rates. So I hope you can see now why pairing a strength against weakness is how you trade FX markets from a global macro perspective. Okay, that means in a balance of probabilities, we expect this to move higher, and then we just use our technicals to define your risk. Now you can still mess up trading like this because maybe you risk too much. Maybe you have very bad levels. Maybe you're too exposed in the market. Maybe you hold on even when something changes. So if for instance, one key risk here would be if this happens. Say we suddenly get cases rising and then hospitalizations start rising and the UK looks going into lockdown and then the pound Swiss franc starts falling, but you just hold your position. Like that would be a good example of doing it wrong. Okay, so I hope that kind of just generally helps with that. Now, I said we'd also look at the OPEC market, so we'll just very quickly look at oil. Now, oil complex has been on a massive run higher. Now, the reasons for oil upside are quite specific. One, demand for the second half of the year is expected to rise, and the revisions keep getting revised higher. Successful vaccinations in places like the UK, US, all boost that demand prospect. Two, politically, investment in fossil fuels is politically difficult now. Why? Green technology is the #1 agenda for a number of infrastructure projects around the world. Green energy is where it's at. Fossil fuels are in the doghouse, so to speak. So that means that current lack of supply in the oil markets, some of that is due to a lack of investment and is not likely to see a huge boost in oil projects, oil discovery, as the world generally moves away from the oil market. Three, we do have a very well supported market by OPEC. OPEC Plus have done a masterful job in just releasing enough oil to the market to keep prices generally bubbling higher. Now, you remember oil crisis has had a terrible time, going even negative in the futures market. Oil prices have been able to make a steady recovery, and now that recovery is moving up, with analysts like the Bank of America calling for a US oil price of $100 by year end. Now, a couple of things to note. One, we are heading into key resistance. So this is a key profit area. Okay, this is a key area we'd expect profit taking. So watch out for profit taking into that region. We also have OPEC meeting at the moment. And the latest, and I'll just go through, I just saw this on the wires just before I came out. Remember, if you're an HYCM client, you get access to financial source, and make sure it's activated. It will give you a host of information. I work as an analyst here. I am doing the video commentary every day. Remember, get there. You can ask me questions, and this is what you want. Now, looking at the where is it? Where is it? Let's have a look. I just saw it just before I came on. I think it must have dropped down the feed. Yes. So Russia has expressed a favor for an increase in OPEC plus oil production. Increase between 500,000 and 1 million suggested. Some members disagree with such suggestions out of the fear that COVID might surge again, OPEC journalist. Okay, so, and that has just been boosting markets, because if they don't increase production, expect this to boost up to the 75 region. Okay, so that's the headline we're looking for, no change. Now, if they boost production by 500,000 to 1 million barrels per day, I'd expect not much of a change. It is possible to get a relief rally back up to that 75 region, but then all bets are off in that 75 region. I'd expect to find sellers at first test around 75, 76. Remember, because that's that key overhead resistance level up here. Remember, markets, they head to resistance levels and they take profit. You see here, even as oil was moving higher, it moved up to that 67, 68 region, hit it, dropped, and then eventually moving out. So what we're looking for here is confidence that OPEC is going to keep supporting the oil market. So if they don't do any change, watch out for a spike high into 75, 76. Then what we're looking for is potentially a break of that 75 region, 70, 75, and if we see a break above there, we could look at a retest into that level. Okay, so potentially a break higher, retest higher again. But what we want to see is no change, or less than 500,000 barrels. Now, if there's something like 1 or 2 million, expect that to weaken oil prices, but expect dip buyers to step in. If the US-Iran nuclear deal gets agreed, expect a sudden spike down in oil, maybe down to 72, 71, but expect buyers to come in the dips. In terms of where's value here, there's a couple of value areas. Number one is any retracement back down to that 68 is great value for oil right now. Secondly, a break above that 77 region and then a retracement will be good value. Here at the moment, it's not great value. Where would you have to run your stops? Just below 71, where you're taking profit up to 75, 76, but you see, you don't know what OPEC are going to do. So they're the catalysts we're looking for. Number one, OPEC not making any changes, oil boost up to 76. Number two, OPEC making 500,000 to 1 million barrels per day production increase. That is neutral. 3, OPEC plus making more than 2 million barrels per day increase, production increase. That is negative for oil, but medium term we'd expect dip buyers. 4, if the US-Iran deal gets agreed, that's around 3 million barrels per day of oil coming back into the market. Expect to drop down to that 71 region, but we would expect buyers on the dips. If there was a US-Iran nuclear deal, I want to see how price goes, but I would personally be a very interested buyer at 68. Using that near-term trend line for now, stay above, bulls are in charge. Not worth getting in at market. We're up at the highs, and we have an event risk with OPEC plus. Second event we'll be looking at now is the non-farm payroll. Now, this is very big news for the dollar. We have seen a lot of dollar strength recently, and just to remind ourselves that dollar strength came out of the very simple news that the Federal Reserve is expecting sooner interest rate hikes, and the dot plot has shifted towards earlier interest rate hikes around 2023. That's where the dollar strengthened. Now the non-farm payroll is going to be key because the Federal Reserve's key focus is employment. If employment is going well, that means the Federal Reserve will taper bond purchases sooner, which means sooner interest rate rises, which means dollar strength. The non-farm payroll data is expected to be good. So a couple of things. One, ADP jobs data is coming out later today, right? And the ADP jobs data, just go to the must read section, is used as a kind of setting the mood for Friday. Okay, so if this jobs data comes in, we're expecting 600,000 print of the ADP jobs number. If we get above 75,000, expect that to really boost the US dollar. Okay, so anything above 75,000 for ADP should really boost the dollar. And although the ADP number is not great for predicting what the non-farm payroll data is, it still is used as a metric for assessing what goes into the non-farm payroll data for some of the models. And even though ADP doesn't give you a great correlation between the ADP jobs number and the non-farm payroll jobs number, think of it more like setting the mood. So if the market's excited for a good jobs number, it will be. Now, one of the reasons excitement is going to start growing for jobs is this. Right, jobless unemployment benefits end in the US around September, but some states in the US have been ending unemployment benefits sooner. Why? Simply because they know that these unemployment benefits will be ending, and so they decide to end them sooner to encourage people back to work. Now, in the states where unemployment benefits have ended, look here, you see the blue line? So where the unemployment benefits ended in June the 9th, the initial jobless claims are dropping. So in other words, less people are claiming joblessness now. Why? Because of course you are not getting any unemployment benefit for being at home. And if you are a low paid worker and the government is paying you to stay at home, then of course you'll stay at home rather than go to work to earn maybe less than what you're earning by doing nothing at home. It just makes sense, doesn't it? Now, of course, the government has been giving these benefits to protect people's economic situation over COVID-19, and it's a very good, caring thing. But it's coming to an end. And so what's expected is that the reason jobs have been low in the US is because of these benefits. And once these benefits drop off, then jobs should bounce back. And these 10 states are good illustrations that that looks right, doesn't it? Continuous claims dropping faster in the 10 states where unemployment benefits ended. Initial jobless claims. So in other words, this is the amount of people who claim new joblessness. This is the amount of people who are continually claiming joblessness, and you see it's dropping faster in the 10 states. So all of that means that the data for Friday should see some good jobs numbers. So expecting dollar strength into that meeting, but look, we have seen quite contained ranges. So what we're looking for is, we'll just have a quick look. Just quickly go to a calendar, and we'll just pull up this week. Right, and what you see here on Friday, jobs expected to come in at 700,000, okay? Now, if they come in above 1 million, okay, and the unemployment rate comes in like below 5%, expect sharp and sudden dollar strength. Expect dollar yen strength to really boost, and expect euro US dollar weakness, and expect gold weakness, okay? So above, say, 900,000 or 1 million, unemployment down to 4.9%, gold heavily sold off, dollar heavy buying, euro US dollar heavy selling, dollar yen heavy buying. Keep an eye on the US 10-year yields. Remember, if you're trading the dollar yen, always keep an eye on US 10-year yields. You see how closely they correlate to each other? A little bit of a divergence at the moment, but generally speaking, the dollar yen is tracking the US 10-year yields. And if we see 10-year yields, you know, break out higher of that trend line, expect dollar yen to really rip up into that 111.50 region. So that's one clear correlation. Slightly diverging at the moment, which is interesting. Notice how closely dollar yen tracks the US 10-year yields. At the moment, seeing a divergence, 10 years lower, dollar yen upside. So look for this to potentially, look for one of these to break in sympathy with the other. Now, in terms of a disappointing data point, if we got something like non-farm employment change, say it's like 400,000, unemployment rate is maybe like 6.2%, that would be negative. And so we expect to see dollar weakness, euro US dollar upside. That would be a good opportunity for euro US dollar upside, and gold upside. That's what we'd be expecting. Okay, folks. Well, I think that is the key things there. Let's just check if you've got any questions, folks. Don't forget, use the question box, use the chat box. That's, you know, that's pretty good. Don't forget, you do use my blog. Check out the Central Bank Watch. By following the central banks, I've done a central bank overview for July. So as a trader, you should always know what all the central banks are doing, okay? Come here and check out my latest article, and you can really speed up your learning there by using that article. You can also make sure you follow me on Twitter. My Twitter handle, I'll put in the chat box. It's at Giles Coughlin CCA, and thanks very much to you guys who do support me on Twitter. Much appreciated. Thank you, Warren. and the others who, like my tweets, share my tweets, helps me get them out. So much appreciated. So thank you very much for your efforts there. And I think that is it, folks. Yeah, that's it for now. Okay. So we should get to the business end of the week now, really. It's been a quiet start to the week, but you expect that. I'll do a quick look at equity markets. Equity markets still remain, buying on dips, but if you want to look at what equity markets, keep an eye on the VIX. If the VIX starts moving higher, expect equity markets to drop lower. Okay, so that's one thing to look at. Seeing a bit of a spike in the VIX today, hence equity markets showing a little bit of a drop. So do watch out for that. Yeah, thanks, Warren. Warren says your Twitter post has very good content. Yeah, thank you very much, Warren. I do work hard to try to make the content as helpful as possible. I don't just chuck any old stuff out there. I always try to put something up that I feel has integrity, is authentic, and is in keeping with the general sentiment that we're experiencing. So obviously, the more your skills grow as traders, then the easier it is to use the information, essentially. Okay, folks. Well, thank you very much. Yes, Nikita, a very good question. Nikita asks a great question. What about the pound US dollar in the next few days and next week? Now, I was covering forexlive.com, Nikita, last week, and I was having a little chat with someone, and they were sort of saying they went long the dollar last week. Can't remember when they were. It was probably around Tuesday or Wednesday, and I was sort of saying, look, yeah, I'm bullish the pound, but don't trade it against the dollar right now because you've got a mixed picture from the Fed. And the chap I was speaking to said, leave me alone. I'm going to trade what I want to trade. You're trying to put doubt in my mind and stuff like this. And the poor chap, took it the wrong way. I was only trying to be helpful, but it does raise an important point. And Nikita, thank you, because it reminds me, which is the problem with the pound is that there's two drivers on the pound US dollar. So first of all, we had this pound US dollar weakness, which came in because of the dot plot shift from the Federal Reserve. So there's dollar strength in the market. And if you have a look here, Nikita, you can see it clearly, right? Can you see that dollar strength? This is the dollar index. Now that dollar strength results in pound US dollar weakness. But there's also some reasons for pound strength at the moment because of the situation in the UK. Low hospitalizations, high vaccinations, UK about to recover. So this is an example when you have reasons for pound strength and you have reason for US dollar strength. So what's going to push this pair this week? It's likely to be the dollar. So say there was some good reasons for dollar weakness, Nikita. I really like the pound US dollar long. So say all of a sudden we got to the non-farm payroll, and say, for instance, the non-farm payroll was terrible. Say it came in like employment change came in like, negative, minus 100,000 jobs, unemployment rate, 6.4%. Then in which case I will be buying the pound at market and looking for back up to 1.4200. Okay. So for now, flat, neutral. The pound I like is, remember that strength and weakness idea I shared, Nikita? I like the pound Swiss franc because there's reasons for pound strength and Swiss franc weakness. Which if you look at the pound US dollar pair, there's reasons for pound strength and US dollar strength. And also the other difficulty with the pound is that it's variable, okay? Will the Delta variant result in more hospitalizations? Will the UK go back into lockdown? So it's not without risks. We could see some pound weakness come back in yet. And remember, to play devil's advocate against my own view, I've been bullish the pound for a while, and I was expecting the Bank of England to be more hawkish this time, and they weren't. So, maybe the Bank of England, there's an old saying in the market, being early is the same as being wrong. You understand? So that's why you always define and limit your risks. You're thinking, where do I get out? If I'm wrong, if I'm early, say for instance, the pound's going to go up to 1.35 and I'm right, but say before it goes up to 1.35, it drops to 1.21, okay? So you've got to manage your risk along the way. So you might say to yourself, well, do you know what? what I'll do here is I will decide that if price goes below this trend line, this swing point, I'll exit. But if it goes back here, you can enter again, okay? A better value, fine. But you've got to define and limit your risk. You've got to avoid that sin, as it were. Being early can be as good as being wrong. Nikita, I hope that helps. I hope you can see why I'm not automatically bullish the pound US dollar pair in relation to what's going on with the dollar. That's the key thing to understand, and particularly in relation, Nikita, to the core concept of trading, which is pairing strength against weakness. That's what we're trying to do here, and that keeps the probabilities in your favor. So I hope that helps, Nikita. Okay, good. Folks, been an absolute pleasure as always. Thank you for your comments. Thank you for your questions. And I am scheduled to be back here on Monday, and we will be doing the look ahead week webinar and getting ready for the coming week. Take care, everyone, and thank you very much. Goodbye. Yeah, good, Nikita. I'm glad that helped. Goodbye.